Good morning, everyone. My name is Megan Phillips, and I am the Business Development Manager for Castle Group in Texas. Thank you for tuning into our webinar, Navigating Insurance Going Beyond Today's Hard Market. We have muted all the participant devices to eliminate background noise so everyone can hear clearly. The view options on your screen can be adjusted to display all panelists by navigating to the view options on the toolbar. Select the side-by-side option for optimal view. Feel free to submit questions at any time by navigating to the Q&A option on the toolbar. Instructions on how to submit a question are being displayed on the screen. The Q&A portion of the webinar will begin at approximately 11:45 a.m. Thank you again for tuning into today's webinar, and now to introduce our expert. Christina McCafferty is president and co-founder of Association Insurance Partners. Her firm specializes in homeowners, townhomes, and condominium association insurance in Texas. Christina brings more than 18 years of insurance and risk management experience and a reputation for honesty, trustworthiness, and superior negotiating skills to her clients. Christina is committed and focused on meeting the insurance needs of each of her associations. She goes above and beyond her duties as an agent to help educate management teams and board members, making her an invaluable resource to communities. Christina received a master's degree in teaching and learning while working as a full-time producer in the industry. She entered insurance with a bachelor's degree in psychology from Washington State University. Since then, she has become a property and casualty insurance agent, certified risk manager, customer service representative, and is currently working on her certified insurance counselor designation. Christina is a longtime member of Community Associations Institute of both the DFW and Austin chapters. And with that, I will turn it over to Christina.
Megan. I'm going to go ahead here and share my screen with you all, just so we have it up and ready to go. There we go. All right. Can you see my screen already?
Not yet.
Well, we had it working a minute ago. Okay, let's try it again. Here we go. There we go. Share screen. All right. Okay, it says it's sharing. You got it now?
Yes, we've got it.
Perfect. Perfect. Okay, so I'm going to go ahead and just play this PowerPoint in the background. It's just going to give you some information, and then I'm just going to tagline on it. There's a couple of pages that have a whole lot of information, so I just really wanted it to be out there for all my property management, the actual property management companies, teams, managers aside. Any of that is just good. So thank you for joining me today. We're going to go over some navigating insurance going beyond today's market. Currently, we are in a very hard market. There's been a lot of chatter out there. So I just got done taking this webinar that was put on actually by CAI. A lot of people are familiar with that. And I was able to get a bunch of this information is coming from my underwriters as my carriers, as some other agents within the market. And it's going to mainly specialize in these association fields, which is good. So let's go ahead and get started. I can figure out how to, there we go, slideshow from the beginning. All right. It went to another screen. Can you still see my screen?
Yes.
Okay, perfect. All right. So let's get started with what it will cost me. So some of the content, and I'm going to explain many different changes that are taking place right now in the insurance market. Also, some suggested strategies to help. What it comes down to is, what do you need to understand about the relationship between price and cost? A lot of my property managers, board members, they're always asking about what the difference is between the price, the cost, and everything. It has to do with these three main components, which is insurance premiums, your loss ratios, and claims. And we're going to touch base on each of these just to kind of help guide us through this whole thing. Okay, so let's go to the next page. This is, what is a ratio? If you understand basically what a ratio is, then you're going to have the easiest way of understanding how they're going to calculate all your premiums. There's the loss ratio, the expense ratio, and the combined ratio. Let's start with explaining, the three main concepts. This is your basic starting point. So I'm going to kind of just break it all down for you. These three ratios are how the insurance business lives and dies on their pricing. The loss ratio represents how much out of every dollar the insurance company collects in premiums do they have to pay back out in claims. So you have how much is collected and how much is paid out. And that's the easiest way to determine how your loss ratio will come up. The expense ratio, an example of that is, if you collect $1 and they pay out 50 cents for a claim, that's a 50% loss ratio. Plain and simple, easy math. If you, that's basically how we're going to figure out like your loss ratio. Then you elaborate and you stick in there the expense ratio. So the expense ratio comes in, and it is, a lot of my property management companies are going to relate to this. It counts all the expenses that the insurance carrier has to pay to operate their business. An example, for every dollar that's collected, if it's 40 cents to operate, then their expense ratio is 40%. And as you can probably figure it out, the combined ratio is these two combined together. So they would take the number of the loss ratio and the number of the expense ratio, which is 50% and 40%, add them together, you get 90%. The average combined ratio from just a couple years ago was averaging in between the 99%, 98%, 97%. The insurance companies were realizing that for every dollar that was collected, they were only making a penny or two or three as a profit. So what they were doing is they were taking their premiums, because they were remaining steady at that time. They were taking them and they were just setting them aside. So it was slow growing, but it was steady. And that is why the market was what we call a softer market. It was a lot easier to get better rates, lower rates on your insurance, things like that. To understand if you're paying a high rate or a low rate, you kind of don't know what a high rate or low rate is. You only know by what you're paying. So if you just take, for example, like the gas stations, whatever rate you're paying, if you're paying $3 for gas, you might think, wow, that's really high. But you don't know, because unless you're in the gas industry, you don't know unless you have all that background. You're not knowing if at $3 is high or not. You don't know. You're just like, wow, this is what I'm paying. And then a month or two down the road, you pay $4. You're like, wow, this is even higher. So if you're not exactly aware of what's going on behind the closed curtains, behind the doors, that's where you tend to find out how they figure out the rates. So this is just going to give you a little bit of a background on how to figure out, to help understand where the insurance carriers are coming up with this money and things like that. And we will touch on a bunch of questions that have already been asked and topics that have already been asked. Okay, so they would take that profit, set it aside, is what we ended on. And then things started to go bad. So an example, in 2022, the combined ratio average was just under 103%. As of now, 2023, the industry is on track to achieve 106% combined ratio. So for my community managers, here's a nice little example for you to work with. Think about this. Your cost per door and your fee that you charge per door to manage the association. If you were to charge $1.06 per door, but you were only getting $1 per door, how long do you think you'd be able to stay in business? Because you're not making that need for your expense versus also your loss. So some drastic changes would have to happen in your pricing. So what would change these main pricing things? Right now, it's claims. Claims is the biggest attribute to insurance. There's the fires, the hurricanes, the tropical storms, the wind hail events, the big freeze that happened in Texas. Many were catastrophic levels of damage. What's happening is that a lot of the expense stuff is being built in the path of these storms, the expensive stuff. So a storm happens, the insurance carriers come in, they pay the claim. What happens after that? They rebuild and the cycle begins again. And it's just more and more expensive stuff that they're putting that's impacting, and this is all impacting not just your property rates, but your directors and officer rates and your general liability rates, because there's different aspects that are coming about on them for claims. What's happening is what's happening there. I'm sorry, I just lost my spot. So that happens occasionally. Okay, so we're going to go to the next screen here so we can get started with the claims portion. All right, let's see. So I do get this question a lot. Okay, but our association has never had a claim. Number one question, why should the combined ratio have an effect on our premiums? In one word, it's reassurance. I'm sure a lot of property managers have heard this word coming out of insurance carriers and agents' mouths. It's reinsurance. These are the operators behind the carriers. They are, as we would call, the wizard behind the curtain. There's a good example for you. These guys come in and they're the ones that have the money. So this is what I learned recently about this. This is what some of our insurance brokers are calling legalized gambling. So an example, if I'm an insurance carrier and I have obligated myself to a $500 million premium worth of property coverage on several condos in Texas. As the day goes by, I'm thinking about it, and I'm more uncomfortable about what I just obligated myself into. So what can I do to make myself feel a little more comfortable about this? If all of these condos were to go down in one risk, it could put me out of business. So what I decide to do is I go out there and I've already agreed to this. I've already collected premiums on it, so I have to stick to it. I've already set it in stone. I got $500 million in property coverage and I'm covering all these condos. So what I do is I go down and I give a call to somebody I know that's in the reinsurance world. Let's call him Warren. And I call up Warren, who owns a reinsurance company, and I say, hey, if I pay you X amount of money for the next year, for the next 12 months, will you agree to cover my losses for up to 300 million of the 500 million I've obligated myself to? And he just comes out and says, sure. So he's taken on that risk for me, and I feel better because he's going to cover any claims that come in for the first 300 million out of my 500 million I've already been obligated to. So that's great so far. Except in the background, and I typically wouldn't know this, Warren's out there making the same deals with 200 or plus other carriers all over the world. So all of these claims happen all over the world, and Warren is the one that's having to pay out. But my clients aren't affected. None of my communities have had any losses. So my 12 months are up. I'm about to redo my contract with him. So I give him a call. And at this point, he says, hey, I know you paid X amount in the last 12 months, but I'm going to need X amount plus 40% more if you want the same deal. So I have two options. I either renew with Warren or I forgo the reinsurance. And again, I could be put out of business within the first year. So of course, what am I going to do? But I'm going to have to go with that. So I accept the X amount and the 40%. So reinsurance is really what it all comes down to. This is the number one thing on how the premiums are adjusted. And this is all the stuff that goes on like in the back. So a lot of people aren't going to know about this right up front, but at least then it'll kind of give you an idea to help with some things to mention to your board members as we go through this little PowerPoint. Okay, so question 2, this is the other big question that I've received, is why is our premiums increased more than the association across the street? I do have quite a few different communities that have asked me, hey, we have the same number of units, the same amenities, we were built the same year, etc. We got hit with a huge increase, but the association across the street was hardly hit at all, and their increase is very small. Why is that? Well, this all still comes back down to your price and your cost. It could be possible that you started off with a low rate for the last 5 years, and because you are currently still with that carrier and they are renewing you, your rate is locked. A lot of the times the carriers will keep your rate as is, and then it'll just add that inflation on there. And that's great. That means you are good to go because you're going to have a small increase every year. It's not happening as much now that 2023 is rolled around and there's more and more claims that people are paying out. The insurance carriers, when I say people, are paying out, and it's just costing them more on their expense ratios. So you could have started with that low rate, like I was saying 5 years ago, but the association across the street could have had a higher rate to start with. And now that the rates are catching up with them, they're steady. They're not moving. They're just moving with the inflation guard, which is typically about 10%. That's the normal inflation, is like about 10% to start with. And they're lucky because they're able to just keep it at that because they've had no claims. The deductible structures could be different. You could have had a higher one, or they could have had a higher one. There's so many things in the background for the reasonings why the difference is. And that's why we as an agent can't really tell you, I'm not sure why you're paying more and they're not. It all, again, comes down to price and cost and how it's calculated. The price you pay with the price someone else pays, that's the foundation of understanding your need to start with. I'll jump into this real quick. There are quite a few carriers right now, let's say in Texas, that have pulled out of the market. They are no longer writing property in Texas just because their loss ratio has just skyrocketed. Their combined loss ratio has gone up, that they just can no longer function with handling all the claims that have come through because of the weather or whatever the reason is, a fire or some other sort of storm. And that's kind of where, that's the easiest way to start when you're looking at things. So it comes down to what the property looks like all across the country. What are the physical attributes? There is a survey that I recently just received that I want to share with you guys. It is featured by the Foundation for the Community Association Research Insurance SNAP survey. Over 900 members participated in this, which is great. This is going to be, and I'll make sure that Megan has access to all of this information afterwards too, so you could take a look at it, because I'm not going to go completely into it. There is a lot of it. But here's the survey. When the question was asked, did your property and your casualty rates go up this year? 91% said yes. So that's over half went up between the 11 and 25% range, because that's what we were currently looking at. This last year was 11 to 25% increase. But then 26 to 50%, they came in and they said their rates were way significantly higher. So this kind of gives you an idea of the breakdowns of the premium increases. It's going to give you, it's a nice little chart here that's going to give you an idea of all the stuff that they look at. But if you're within that, the people that were in this 91% yes rate they're actually good. If they only went up by under 50%, that's good, because renewals right now that we've seen, including myself, I've seen, are ranging anywhere from 50% to 300% on an increase, which is just crazy sky high. But that's what we're looking at just because of all these factors. So if you look at these factors, the geographical risk that you can't control are all the weather, that the storms that come through, and it happens across the board. So we're talking like, even though something big and big catastrophe happens in Florida, Texas is going to be affected just because the carriers that work all over the United States, or even once they blow into London, but we're just going to talk about the US, then they're the ones that have to look at their ratios. And that's when they determine, okay, we're going to have to increase somewhere. There are controllable factors, and that's what I wanted to get with, and kind of just present to you guys some help on these controllable factors. Controllable factor one is age of your community. Yes, you cannot control the age of it. Obviously, it gets older every year, but you can control the aging process by maintaining. So your age of your community, your age of your roof, your total insurable value, your claim history, these are all controllable with the help of everybody within the community. So we're talking management teams, board members, unit owners, homeowners, just all of the above. There's things that we can definitely help. So if you take care of it and you maintain your community, which is always changing, then you're going to have a good investment that's going to help you in the long run. If your board doesn't want to make this investment, they don't want to raise the money, they call this the deferred maintenance. Underwriters do not like deferred maintenance. To them, it is a bad word. It's pay more in the long run, which means you're going to pay more on your insurance premiums if you defer your maintenance. Some carriers they have absolutely no tolerance to a roof that's over 15 years old. If you have an admitted market right now, let's just say like Travelers, AmTrust, those are all admitted markets, which means they are registered with the state of Texas, let's say. Then if you currently have a roof with them that's over 15 years old, they can turn around on a claim and actually charge you actual cash value versus replacement cost on your claim. That means you're leaving your depreciation on the table and you're not able to go back and collect that. Another question that's popped up recently was, can my carrier drop me because of an old roof? And the simple answer is yes. They can easily non-renew you or drop you because you're now outside of their stipulations. So the best thing to do is always maintain. Keep your communities maintained. And a big one that I'm seeing is aluminum wiring. So back in the 60s and 70s, aluminum wiring is how all buildings, all condos and stuff and other buildings were just built. But in the 1950s to the 1990s, that's when they started adding these things called Federal Pacific electric panels, and they had those installed. And some of the admitted markets right now were aware of these and they were okay with being on it, on the risk for a while, but now everything's changed. So if you have a Federal Pacific electrical panel, there are now limited down to maybe 3 markets that will actually write your insurance for aluminum wiring. These are going to be your older communities. And the best thing to do is, again, maintenance. Try to get everything upgraded to copper wiring. I know it's going to be super expensive because I'm going through this right now with one of my condominium communities, and we've gone through the electrical process of finding out how much it's going to cost, how long it's going to take, are we going to have to do special assessments, et cetera, et cetera. Is it going to save us on our insurance premium? That's their big, what they want to know. They want to know right away if it's going to save them money. Well, of course it is, because you're getting rid of the number one thing that can happen as a fire within a community. Carriers are risk adverse when it comes to aluminum wiring. So these are only insurable by what we call our surplus markets, our secondary markets. So we have our admitted markets and our surplus markets. The surplus markets come in and then you're just basically having to now start paying taxes and fees on them. And that's the main difference between the two. We still, as an agent, we do no business with anybody, no carriers that are under an A rated. So that's typically, you don't have to worry about that if your broker or your agent is somebody that only does business with A rated carriers. So carriers want to review your last 5 years of loss runs. Okay, to talk about like the claims history, this has always been an issue for carriers. We are working on a habitational risk. This is a claim-ridden industry. Carriers are going to want to see these 5 years of loss runs. They're going to want to review them. They want to know what kind of claims you've been having, the severity of the claims, the frequency of the claims. Did you just have a one-off fire claim that was catastrophic? And that's what's driving your loss ratio up, because we did have that freeze that happened in Texas, and that drove a lot of people's loss ratio up. But a lot of the insurance carriers did not really use that against them because of the situation that it was a one-off so far. Fingers crossed. But if you only had that one-off, sometimes you're a little bit luckier, but this is where the loss ratio is going to kick back in. If the loss ratio is in excess of 50 to 55%, most likely your carrier is going to non-renew coverage, decline coverage, because you are now an unprofitable account for that carrier. So that's when you're moving into the surplus carriers, because a lot of admitted markets are not going to, they're just not going to quote or be interested in communities that are over that 55%. things that you can do to control your claim history. If it's related to deferred maintenance of your building, then, look into it. If you have a history of water losses, which I'll tell you, water losses are the number one claim right now in community associations. If you have a history of it, what are you doing to control those water losses? Do you need to replace the pipes? Do you need to install water sensors that give you an early alert to leaks happening? The education also to your unit owners as to what they can do to control losses within their unit definitely helps. So any of this extra knowledge that we can put out there is it's a bonus for the communities. If you're already working on your path to achieving a better community, then that's great, because you're not going to have to go through all of these hoops. On the next slide, we'll talk a little bit about that. I'm going to touch one more thing on here, which is your total insurance value. So this is your replacement costs. So how much does it cost to rebuild your building? There's a labor shortage, there's inflation, there's the cost of construction is up right now, the cost of materials is up. So your building values, if they haven't been adjusted in the last 5 years or so, they're going to increase this year no matter what. Most of the renewals are driving the premium because we're increasing the TIV. So that's a big factor of how your insurance premium is increasing right now. And again, remember, the loss ratio is calculated by how much premium the carrier has collected versus how much they paid out in claims. So that'll help remind you again how you come up with your loss ratio. So here's what I said as areas of focus. If you're already working on that path of achieving a better community, this is great. This is where this comes in and helps you. So I'm not going to go through these exactly list for list, because some of the stuff we've already covered, but these are attributes that carriers will flock to. So how can you take care of your building and they want to see you taking care of your building physically and financially, perspective wise. They want to see all of that. Do you have a reserve study? Are you complying with the recommendations set forth in it? If you have a reserve study and then they turn around and say, hey, in 2020, we need you to replace all the roofs on these 5 buildings. And it's now 2023. You haven't done it. If an insurance carrier gets wind of this, sees this, on your report, they're going to want to know, why haven't you replaced the roofs yet? And then that's when they're going to come in and ask for the engineer inspection report. Do you have an engineer inspection report that supports your decision not to replace these roofs? Because they could be fantastic wind hail 40-year roofs, and there's absolutely no damage to them at that point. As long as you have a report, then you have a better shot of getting an admitted market to write your insurance, and you still have what we call a newer roof. The major updates, what are the major updates that you've made? What are your plans for major updates? Any of that stuff that you have, any of that information a carrier is interested in, all of that. It's always good to get that information out there because it does help with your premiums. When you work with your broker on your renewals, this is a big one. It is important to submit complete data to them so that they can submit to the marketplace in order to get you the quotes that you need in a timely fashion. It is really crazy right now out there for underwriters. They are backed up with all these changes. Carriers have pulled out of the market, as I was mentioning. So underwriters are backed up even more. And then the agents are having to wait on the underwriters. So there's always a third party involved. And then you've got you're a property manager. So you're stressed out because you've got the board yelling at you, hey, where are my quotes? It's 30 days out. We don't have anything yet. There's so many factors behind it. But if you can get a full submission, then your agent, your broker can push that full submission in to their underwriters, and that will actually hit at the top of the pile. If you're missing data, then they're going to push you towards the bottom of the pile because they're going to want more favorable results. So unfortunately, we have to have full submissions these days, and they're asking for more and more information. Like they want those loss runs. They want the reserve studies. I had an underwriter just ask me this morning for a list of owners in a condo community, just as proof that all of those condo buildings have been sold and they are owned by somebody other than the developers that are still currently building at the time. So there's a lot of factors out there. Any information you can provide helps. This is information on the continued hard market throughout 2023 and 2024. Our capacity is still going to remain restricted. So I threw this in here for you as a takeaway. This was a slide that came from one of the webinars I had just done, and this is information from one of the property carriers that I actually currently utilize. And this was all the information that they found out about the how it says disruptions in programs due to shortage of available capacity. So that's, you've got your markets that are pulling out of your state. You've got they're hitting their capacity based on their reinsurance. Then you're seeing the increased retentions. Retentions are deductibles. So it talks about those, lots more increases. You know, we're looking at 5% as your minimum wind hail deductible right now. Like that's what they're looking at. And of course, anybody in Texas knows water damage deductibles have already gone up to 100,000. There are so many different things that are in here. So I wanted to give you this as a takeaway to kind of read over. It's just information for you. And I mean, maybe it'll help you sleep at night if you read it. I don't know. I mean, I'm an insurance guru, so I love reading this stuff, but this kind of just is a takeaway for you to help. So how do we get there? As a community association leader, we live, eat, and breathe associations. Your best thing to do is to engage your team of community association specialists early and often. I do get lots of people who reach out to me questions about everything under the sun that has to do with a homeowners association, a condo, a townhome, even a medical office building. I mean, it doesn't matter. They just have all these questions, and that's great. You want to make sure that you have access to like a risk management specialist. If they are CERNS designated, then it's perfect, which I'm currently working on finishing mine. So I will be a risk management specialist officially designated in the state of Texas here pretty soon. If you have a reserve study specialist, that'll help. You know, adopt a maintenance plan. There's different things you can go out there adopting the plan to kind of help you get there. How are you going to raise money to absorb the premiums? Are you going to have to do a special assessment? If you have to take out a loan, you want to make sure you're working with bankers that know community associations. You don't want to just go to a random bank and take out a loan that doesn't really actually specialize in it, because then they're not going to understand the dynamics behind it. Just work with understanding the world of community associations. Anybody you can find that works with them. A lot of the time, CAI is a huge reference. Anybody that works with CAI will know that they have a whole booklet list of all the different vendors you can find and different people to ask information. There's lawyers and bankers and insurance agents and landscapers. I mean, there's a ton. And then on this, just make sure you budget accordingly. So you're working on those deferred maintenance. So make sure you budget, budget, budget. That's a big thing that we're having a harder time with. I know it's hard to collect dues and things like that for these associations, but this is kind of just to help you get in there and find out what else you can do to get to the better points. And I'm going to touch on directors and officers a little bit, but I'm not going to go too deep into it because there is a whole nother webinar that can be done on it. Plus, anything having to do with directors and officers, if I do not know the answer, I go to my D&O guru. I ask him everything under the sun because I do not want to say anything wrong about this, because this one right here is a very touchy subject for a lot of people. But all roads lead to a potential D&O claim. So anything that we just discussed, a lot of these issues can be triggered, can trigger some D&O claims. So these are a few little bullet points of what we're seeing lately that happen. An example would be like a special assessment comes up out of the blue and a unit owner's like, why am I getting this special assessment? Why? I don't have any information on why I'm being charged. Should I just sue? A lot of people are out there just wanting to sue left and right. Doesn't matter, just because they think that they're in the right and somebody's in the wrong. And that's not always the case. No, not it's sometimes it's not anything wrong. Unfortunately, it's just the world we live in, and the prices of insurance have gone up. So we've had to do a special assessment. As long as you put it out there in writing and you go through the proper channels, then you're protected as a community for putting out this information. The part on like the corporate America, I've found out that that's like people just thinking that the insurance companies are out there collecting all this money and they're not paying these claims, because not all claims are paid. I'm not a claims adjuster, so I can't really go into that, but everything is, I just know that there's all these things behind the works and there's all these specialists you go to, and they're the best resources for each of these. So here's some rising defense cost bullet points for you and some other factors to consider, because there are a lot of new laws being in place, especially over in Florida, having to do with the big Surfside condominium that came down. After that, finding out that they were underinsured, there is now a law going to take place. So of course you want to make sure that you go through CAI, because they do have all their law webinars that come up, and they are the ones that can get you that information on these updated laws that are coming into place or have already passed, and anything having to do with Fannie Mae, all of that. So that helps too. But you know, to put it out there, you've got board members who are suing each other because they can't get along. They're not realizing that they're suing themselves when they put in a D&O claim. So if you can, the more information you can get, the better you are, and you'll be able to stay under and not exceed that $1 million limit that you have on defense, because right now defense costs are through the roof. They are just rising because more and more people are just prolonging the claims, and they're just taking longer to close things off and not coming up with a settlement strategy. But that's all I have for you. So thank you for letting me speak today.
We do have a couple questions. The first one is, do management companies receive commissions or incentives from insurance agents or carriers?
That is a very good question, and I cannot answer it completely. I can only tell you what I've heard through the grapevine, and I don't have a lot of facts on it. There are some management companies that have their own insurance carriers, and they're owned by the same companies. So I would assume there's some sort of kickback there, but that's just, again, that's not something we really know. I can tell you, like, our company, we don't pay management companies for bringing stuff to us, and we don't have any of that type of kickbacks. There's no master programs out there where if you bring me all your book of business, I'm going to give you a kickback for bringing me some of yours. The only ones I've seen, and I've seen a couple of them just because I did sit on an HOA board for 2.5 years to get a feel for what property managers are dealing with on the board side. I've worked with property managers too to see kind of that. But I would just say, like, it's mainly if it's a property management company that owns their own insurance company, there's probably something behind the scenes going on, but I don't know. I really don't know for sure. And I don't know if I can really get that information for you.
I can actually speak on behalf of Castle Group. We do not receive any incentives or commissions. We are vendor agnostic, so our goal is to secure those bids, those insurance bids for you. But there is nothing between Castle and the insurance brokers that we work with.
Right. And I have that same, I don't have any that I work with that do that either. So I'm not really familiar with it.
We do have another question. Our HOA community is 20 years old, and our only insurable asset is a masonry wall, approximately 1 city block in length. We've maintained this asset as reflected in our reserve study. Given this and 0 claims in 20 years, any recommendations?
Oh yeah, actually it seems like that's actually a pretty nice insurable profitable HOA. So I would just basically take it to your agent of choice, or feel free to send it over to me and I'll take a look at it. But knowing that information and the fact that you have that reserve study, that's the information that you relay back to us as your agent or your broker. And then we will take it to our underwriters. And a lot of the times it's relationship too with our underwriters. Like, we get in there and we say, look, I've done risk management on this community, and these guys are awesome. They have a great management team behind them. And sometimes that helps too. A lot of the time, if you have a great management team behind you, like the way that Castle Group works with their communities, and they're always on top of making sure the budgets are done, making sure that they get the maintenance done, that type of stuff. If you have somebody who's working with you on all that, that helps tremendously in the insurance industry. Like, you just get out there, you let us know. I mean, security cameras are really big right now. If you have a security camera, that right there can already help, because there are some carriers that will deny you because you don't have that security if you're in a high theft zone. We are seeing a lot of that right now too, especially in the DFW area. Their scores are coming up as a high theft area. And if that's the case, we are having some of the carriers decline coverage because of that. So if you have cameras or some other system in place to help with that, then you have a better shot of actually being insured by a carrier that's not interested, and you could get better rates.
Great, great. Let me see. It doesn't look like we have any other questions. We'll give it another minute or so. If anybody wants to type in a question, we are absolutely willing to answer all of your questions. Let's see. It doesn't look like any other questions are coming through. So with that, we will wrap it up. I want to give a special thanks to Christina for being with us today. Your presentation was very informative. I know insurance is a very hot topic with associations these days, and there's a lot of questions around it. So you were able to clarify a lot of that for us. So thank you. We will be posting this recording on our website. So if you'd like to go back and re-listen or look at some of the slides, that'll be available to you on our website starting tomorrow. So thank you, Christina.
Thank you
and
for
thank you
having me.
everybody for participating. Oh, wait,
Thank
we've
you so
got one
much.
more question.
Oh, yeah.
We have a well done. Thank you. Thank you, Ed.
Thank you.
Okay, everybody have a great day. Thanks a lot.
Thanks.